This video is going over 12.1, calculating employee earnings. We have two objectives. You need to be able to explain how employees are paid, and you need to be able to calculate hourly employee earnings. So first we have a bunch of terms. Wage, the amount paid to an employee for every hour worked. A salary is a fixed annual sum of money divided among equal pay periods. A commission is a method of paying an employee based on the amount of sales the employee generates. Total earnings is the total amount paid by a business for an employee's work, earned by a wage, salary, or commission. And then total earnings are sometimes referred to as gross pay, gross wages, or gross earnings. So typically when we have an employee, we are either going to pay them a wage or a salary. So wage means that you get paid for every hour. A salary is that we have a set amount for the year and then we break that up among periods of time. Commission is like an additional way that we may pay an employee, and that's usually going to be a percentage of sales or something to that effect. So with this down here, the total earnings, so the total amount paid by a business for the employee's work, just know that there are many different terms for how we can call that total, or what we call total earnings. But throughout accounting, we will always refer to it as total earnings. Okay, so a pay period is the number of days or weeks of work covered by an employee's paycheck. So here are some examples of pay periods: weekly, bi-weekly, semi-monthly, and monthly. So if they get paid weekly, usually it's going to be a certain day of the week. So maybe it's every single Friday that they get paid. Bi-weekly means like every other week. So every other Friday they get paid. Twice a month, usually what we see here is that we pick out 2 days of the month. I would say the most common that we would see would be the 1st of the month and the 15th of the month. And then the last one is monthly, so it's just once a month. As a teacher, that is how I get paid. I get paid once a month. So our payday is on the 15th of every month. Payroll is the total amount earned by all employees for a pay period. Payroll clerk is the accounting staff position that compiles and computes payroll data and then prepares, journalizes, and posts the payroll transactions. A time clock is a device that's used to record the dates and times of each employee's arrivals and departures. Time clocks have changed so much over the years from what they used to be. So it kind of depends. Way back in the day, we didn't actually have a time clock for my first job. We just had a sign-in sheet. So we literally signed in from the time that we got to work, and then we signed out from the time that we left work. Now, I would say that we have made many advances in that, and the biggest reason why is because I could have easily written down that I got to work 15 minutes earlier, a half hour earlier than I actually did. And again, when I was leaving work, I could have wrote down a later time. So then I would have gotten paid more. Now, even if we're saying 15 minutes, it doesn't seem like that big of a deal. But over time, if I'm getting paid 15 minutes every day, or getting paid for 15 minutes longer every day, that time is going to add up. There are time clocks where you have to punch in like an ID number to clock yourself in. There are ones where you might have to do a fingerprint to clock in. Another one that we saw back in the day, a time clock where it actually stamped the time for you. It was like a little card that you would put in and it would stamp the time for you. Now, the issue that we saw with this one as well is maybe I have a really good friend that's already at work and I say, hey, can you clock me in? And they would be able to then have my time card stamped for me, even though I was not at work. So I think it's just that time clocks have evolved to be a little more accurate. One thing that we have to do from our time cards is we have to calculate employee hours. Again, this is something that's evolved in that we've made it a lot more computerized, so it automatically does this for us. doesn't mean that we don't know how to we don't need to know how to figure that out. So here we're seeing times that they're clocking in and times that they're clocking out for their morning and their afternoon. So it looks like they have a lunch break from about 12 to 1. And then we're seeing that the total time in the morning, time in the afternoon, total is 8 hours. That's a regular workday, is 8 hours. Now, when we look at this one, they have that regular workday of 8 hours, but then they're also clocking back in the evening and they're working from 6 to 8:30. So that is another 2.5 hours outside of their regular 8-hour day, and that then becomes overtime hours. Another thing that I want to point out too is that when I'm calculating these, I see 7:59. We're going to round that, and that's going to be 8 o'clock. When I see this one too, 8:05, we're going to round that, and that's going to be 8 o'clock. So usually we round to that nearest hour. After we calculate the hours per day and then the overtime hours, we're then going to calculate our total regular hours. So those are those 8-hour days. And then we're also going to calculate, we're going to add up any overtime hours. So here is another way that we're going to see this. So this is more of a computerized system. And so when we're looking at this, I don't actually see the time clocking in and out. I'm just seeing, okay, they worked 8 hours on Monday, they worked 8 hours on Tuesday, Wednesday they worked 8 regular hours, and then they worked some overtime hours as well. And then over here on the right, we're seeing just a running balance of their hours. Okay, now we're going to look at how we're going to calculate our regular earnings and our overtime earnings. So this person worked 88 regular hours. A regular work week is going to be 40 hours. Anything over those 40 hours, we're going to get paid overtime, or we're going to have to pay our employees overtime. Now, that's going to, this 88 is more than 40 hours. However, it depends on the pay period. So I believe that this one was like a 2.5 week. What was I looking at? Oh, this one is a semi-monthly. Okay, so we're looking at the December 1st through December 15th for that pay period. Okay, so 40 hours a week during that pay period. They have 88 hours here. Their regular rate for their pay is $15 an hour. So we're going to take 88 hours times 15. Here's our regular earnings then. Now what we need to do before we calculate our overtime earnings is we need to calculate the overtime rate. And so here we see the regular rate is 15. Overtime rate is going to be at least time and a half. Some businesses will do different. Some businesses will pay double for overtime. It really just depends. So on this one, we're seeing, okay, the regular rate is 15. We're going to multiply that times that time and a half to figure out our overtime rate. So our overtime rate is $22.50. Then we're going to take our overtime hours times that overtime rate to get an overtime earnings. Now to get our total earnings, we're going to take our regular earnings, that should not be a times, plus our overtime earnings to get our total earnings for that pay period. Number one, what is a payroll? The total amount earned by all employees for a pay period. Number two, identify 3 methods used by modern time clock systems to record employee arrival and departure times. So I did not go through all of these. There are lots of different ways, I would say now. These are just some examples. Employees can swipe their name badges. So it might have like a little magnetic strip on it so that they swipe their name badges to clock in and out. I did talk about that ID number or a finger print for them to record their arrival and their departure. Also, I'm going to go back to this. Also, we might have a combination of both as well. So I have heard of some businesses that they clock in with their ID number and their fingerprint. Number 3, describe the overtime rules of the Fair Labor Standards Act. So this act requires that most businesses involved in interstate commerce to pay employees at least 1.5 times the normal hourly rate for hours worked in excess of 40 hours per week. Really, what that's stating is that overtime needs to be paid at least 1.5 times the regular pay. This is where I did talk about we might have businesses that pay over that 1.5 times, but 1.5 times is what they need to pay. Number 4, how does 3 Green calculate overtime earnings? 1.5 times the normal hourly rate for the hours worked more than 8 hours per day or 40 hours per week. So it depends on how they're looking at this. So we might maybe we work 10 hours in a day, but if maybe we only work 4 days a week, that does not go over those 40 hours a day. So therefore it would not be overtime. That was the end of 12.1. We can now go to the 12.1 work together.